Stop what you're doing. Literally, if you own any real estate investment trust right now, you need to hear this fundamental breakdown. I'm going to start with a statement that might shock you. Commercial real estate is absolutely not dead. You've just been looking in all the wrong zip codes. I know the constant nagging fear for everyday retail investors right now is getting crushed by the so-called retail apocalypse. We all see the images of dying indoor malls and empty storefronts, and it's terrifying for a dividend portfolio. But last week, I dug deep into the fundamentals of a company quietly dominating the exact recession-resistant places you already visit every single week, and what I found completely shocked me. Think about it like this. If legendary stock picker Peter Lynch were looking for the ultimate buy-what-you-know compounder in today's chaotic market, this company's blueprint would sit right at the top of his checklist. By the end of this explainer, you'll know exactly if InvenTrust Properties, trading under the ticker IVT, is a bulletproof income asset you need to steal for your own framework or just another value trap. We're skipping the fluff. Let's decode the anatomy of this fascinating Sunbelt REIT. 96.4%. I have to ask you a bold question. In a world where financial headlines constantly scream about empty retail spaces and everyone buying everything online, what kind of commercial real estate still commands a massive 96.4% leased occupancy rate? The answer is InvenTrust. This single, staggering statistic proves their specific flavor of real estate isn't just surviving, it's practically bursting at the seams with demand. It's the ultimate proof that not all brick and mortar is created equal.
Here's our roadmap for today's explainer. First, we'll define the essential retail REIT. Second, the evolution of InvenTrust. Third, their Q1 2026 financial performance. Fourth, the Sunbelt strategy. And finally, dividends and Wall Street sentiment. Let's jump in.
Section 1. The essential retail REIT and grocery-anchored stability. Now, what's really fascinating here is that 89% figure. InvenTrust owns interests in 73 properties, spanning over 11.6 million square feet. That is a lot of space. But they aren't messing around with giant enclosed fashion malls. They focus relentlessly on essential retail. Think about your local neighborhood shopping center, the one where you buy your weekly groceries, pick up your prescriptions, or drop off the dry cleaning. 89% of their portfolio is anchored by a grocery store. This is basically the textbook definition of recession-resistant real estate because it's tied to everyday consumer needs. It literally doesn't matter what the broader economy is doing, people still need to buy food.
Moving on to Section 2, the evolution of InvenTrust through a strategic pivot.
This timeline is honestly super interesting because InvenTrust wasn't always this highly tuned, grocery-anchored pure play. They actually launched back in 2005 as Inland American, which was this massive, multi-sector, non-traded REIT. It was kind of a sprawling mass. But look at this deliberate transformation. In 2014, they chopped off a $1.1 billion hotel portfolio. Then in 2016, they unloaded their student housing division for another $1.4 billion. They completely trimmed the fat, dumped the non-core assets, and rebranded as InvenTrust to focus purely on open-air shopping centers. By the time 2021 rolled around, they had sculpted themselves into a focused powerhouse and officially went public on the New York Stock Exchange. It's a masterclass in pivoting.
Section 3. Let's look at their Q1 2026 financial performance and the bottom line.
Before we look at the raw Q1 numbers, we need to do a quick jargon check. In the REIT universe, we don't really rely on standard net income. We look at NAREIT FFO, or funds from operations. FFO is absolutely crucial because it measures the actual cash being generated by the properties. It adds back the massive accounting depreciation of real estate that otherwise completely distorts a company's true profitability. If you're evaluating a REIT, FFO is your North Star.
So keeping FFO in mind, look at this table. You'll notice standard net income actually dipped from $6.8 million in Q1 2025 down to $5.2 million in Q1 2026. Now, if you stopped right there, you might get spooked and walk away. But wait, look at the NAREIT FFO per share. It actually grew from 48 cents to 53 cents. That right there is the cash engine working flawlessly. On top of that, same property net operating income grew by 2.6%. This is solid proof that their operational strength on the ground is actively expanding, despite what that net income line implies. And it's important to note they aren't just sitting on their hands with their current portfolio. InvenTrust is aggressively deploying capital. In the first quarter alone, they dropped $123 million on high-quality acquisitions. We're talking new properties in Phoenix and Atlanta, and a really crucial $88 million purchase to break into the booming Nashville market. That Nashville property is a power center shadow-anchored by Target and Costco. They are clearly on the hunt for expansion.
Section 4, the Sunbelt strategy and where the growth is. In real estate, we all know the cliché, location, location, location. Well, 97%. That is the massive portion of InvenTrust portfolio located exclusively in the Sunbelt. It's incredibly deliberate. They have intentionally parked themselves in the exact geographies experiencing the highest population migration and job growth in the entire country. Simply put, more people moving to the Sunbelt means more people buying groceries at InvenTrust Properties. It's a beautiful demographic tailwind.
Now, how do they maximize revenue once those shoppers actually arrive? This is where their brilliant dual revenue model comes into play. Just look at the massive difference in annualized base rent, or ABR, per square foot. They charge their giant anchor tenants, like the big grocery chains, a relatively low $13.05 per square foot. Why give them a deal? Because the grocery store guarantees consistent heavy foot traffic. Then, InvenTrust turns around and charges a massive premium, $34.01 per square foot, to the small shop tenants clustered around that anchor. We're talking the local nail salon, the pizza place, the boutique. The anchor provides a stability, but those small shops, they deliver the high margins.
And the underlying demand for this retail space is just off the charts right now. They currently have a 130 basis point spread between properties that are leased versus properties that are actively paying rent. That translates to $4.6 million in signed annualized base rent just waiting in the wings to come online. Even better, when old leases expire, they're signing new ones and renewals at a blended spread of 10.5%. They have so much pricing power right now that they can easily bump up rents by double digits simply because their locations are that desirable.
Section 5, Dividends and Wall Street Sentiment. Let's look at the money.
If you're a dividend investor, a reliable, steady climb is exactly the kind of chart you want to wake up to. Back in late 2021, they were paying out about 19.5 cents per share. That grew beautifully to over 22 cents in 2024. And fast forward to 2026, they've bumped it up again to a rock-solid 25 cents per share per quarter. That's exactly $1 annualized.
That annualized dollar payout gives InvenTrust a current dividend yield right around 3.01%. Now here is where their financial discipline really shines. They aren't overextending themselves to dangle a flashy high yield. Their payout ratio sits very comfortably around 68 to 70%. This means the dividend is incredibly safe, and it leaves the company with plenty of retained cash to go out and fund those $123 million Sunbelt acquisitions we talked about earlier.
So, what do the pros on Wall Street think of all this? The consensus rating right now is a solid moderate buy. While the average one-year target sits around $32.60, the major players are actively raising their expectations. Wells Fargo recently bumped their target up to $34, and Bank of America pushed theirs even higher, up to between $36 and $37. Throw in the fact that almost 62% of this stock is held by institutional investors, and you've got a very strong baseline of professional, smart money confidence in this asset.
I think this quote from InvenTrust's president and CEO, DJ Busch, perfectly summarizes where the company stands today. Following their recent results, he said, "With meaningful embedded growth, disciplined capital allocation, and sustained leasing demand, we remain well-positioned to deliver durable cash flows and create long-term shareholder value." It's pretty clear. They know their exact niche, they stick to the playbook, and the cash flow consistently follows. We've covered their massive 96.4% occupancy, their incredibly smart pivot to the Sunbelt, and their double-digit rent growth on renewals. Now I want to leave you with a question to chew on. Take a hard look at your own portfolio right now. How does a heavily leased, essential retail Sunbelt REIT fit into your long-term dividend strategy? Are you genuinely exposed to the right kind of real estate? Thank you for checking out this explainer. Dig into the metrics we covered today, and we'll see you next time.